the March employment report, and it is not a good one. 120,000 jobs added in the month of March. The unemployment rate did drop, though, to 8.2%. John, this is going to be a big surprise for markets.
Big disappointment for markets. We got to see what's behind that unemployment rate number. If there's actually more employment gains in the unemployment rate number, then maybe that'll soothe things. But I think people were geared up for a number of 200,000 or more, and they're going to be talking about QE3 all over again and about the economy losing some momentum, certainly.
QE3, of course, another round of easing from the Fed that traders had been expecting. They lost a lot of their excitement this week when the Fed suggested the economy might be improving enough.
They've been expecting it, and then they weren't expecting it, and then they were expecting and they weren't, and so now they go back towards expecting it, which might be the upside of this. I think from the Fed's perspective, it keeps it on the table. This doesn't push them closer necessarily to doing any more efforts to ease financial conditions, but it certainly keeps it on the table. And the Fed is still trying to figure out this puzzle that they've been wrestling with of why the job market had been doing so much better than the rest of the economy. Now they get another piece of the puzzle. They say, well, maybe the job market hasn't been doing that much better than the rest of the economy.
And of course, we do have to get into the numbers. We have some indication, we knew coming in, that the prior months might have been a little bit better because of good weather. It's been unseasonably warm coming out of the winter, and we could just be in a payback period for a few months, but this is far off the mark of what people were expecting.
It's off the mark, but what I always say when we look at these numbers is, a difference between 120,000 and 200,000 in a labor force with 130 plus million people is really small. We're talking about hundredths of a percentage point off. So I wouldn't read too much into these things, but the momentum certainly doesn't look like it's as strong as it did a month or so ago.
Let's get a few more of the numbers. Go to Phil Izzo, who's over here on our news desk. Phil, what are some of the other big figures we're seeing?
Yeah, it's a pretty ugly report. I mean, the drop in the unemployment rate looks like it's a big part due to people dropping out of the labor force, which is a turnaround from a trend we have been seeing so far this year of people feeling more encouraged and coming back in. What we call the participation rate, which is the amount of people who are out there looking for work, that fell this month, which is again going in the wrong direction. And we saw some industries cutting jobs that had been adding. Like retail trade cut 33,000 jobs last month. That could be some sort of, we've talked about the weather payback. It could be that there were some of that hiring that comes later in the spring got pushed back a little bit. But it's really, I mean, it's job growth, but it's extremely muted, and this is not the type of growth we're going to see to bring down the unemployment rate.
Exactly, not the type of growth people expected. Phil, we'll come back to you in a minute. We are joined not just by one Fed expert, but by two. We have two of the world's leading experts on the Federal Reserve with us today, talking about the jobs report. Let's go to Washington. David Wessel is with us. And David, this seems like vindication for Ben Bernanke, who has been skeptical of this recovery and whether it was going to last. Is he going to, how is this going to affect his thinking?
Well, I think it's interesting that almost everybody has had some incentive to be glum about the recovery. The Republicans have wanted to say that President Obama is screwing it up, and President Obama has been reluctant to be too wildly optimistic about the economy because we still do have 8.2% unemployment. And I think for Ben Bernanke, at least as I read it, I'm interested in what John thinks, is that he's been trying very hard not to take QE3 or further Fed action off the table, precisely because we've been in this situation before, where we had a couple of strong months where the economy looked like it was coming back, and then something went wrong. And this could be one of those things where the year got off to a great start and then it petered out.
He's been trying to take it off the table, but at the same time, he's trying very hard not to push it. And the market seems to be kind of on this razor thin edge of thinking they either are or they aren't, when basically the Fed is just kind of waiting to see how the data plays out. David, what my read here is that the news here is almost that nothing has changed. We had a tenuous recovery a few months ago, and people were gearing themselves up thinking maybe it's stronger than they thought, and now we're back to the tenuous recovery narrative. Is that the way you look at it?
Yeah, absolutely. I mean, I was always a little nervous about the notion that every month was going to be better than the last, and we were going to go back to the conventional recovery where we pick up steam and before you know it, we're back to some kind of normal. There was no reason to believe that it was going to be like this. We still have a housing problem. We still have people trying to pay off their debts. And we still have this big uncertainty from Europe. Are they going to tip over the apple cart again? So I think this will be a very sobering report. as you point out, the difference between 120 and 200,000 jobs in the scheme of the economy with over 100 million jobs isn't very big. But in terms of perception, this will be seen as the risk. This will bring all the questions about the economy stumbling back into the forefront.
You know, the other subplot I think that is going to get some play in the next few days is the seasonal story, right? Because it seems like for the last 2 or 3 years, we have some good numbers at the end of the year and early in the year, and then it peters out. And here we are in April looking at a number that's disappointing as we get deeper into the year. You know, I've looked at these seasonals. It's kind of hard to make sense of whether there really is something there to the seasonal factors and the data being off, but I think we're going to be talking about that.
It's going to generate a lot of distrust about the data. A lot of people don't trust it already. They're going to be wondering whether we've been fooled for the last few months, whether we can really be making all these predictions based on the jobs figures. And John, the Fed, of course, is going to be meeting in a few weeks, and they will be updating their economic forecast. This is going to certainly weigh on them.
I think this, you know, I think their forecast pretty much, I think this reinforces their view that output isn't growing very fast, and that the improvements that we've seen in the unemployment rate might not be sustainable. So I think, you know, they sit tight at the next meeting and then try to get into June and see if they have more pieces of the puzzle and enough to make a call about whether to let the easing end or to do a new round of it.
David, stay with us. We're going to go back to Phil Izzo now, who has been digging into the numbers to give us more. Phil, any other trends we're seeing here?
Well, there's some of the forward-looking things that we look at, like temporary workers and the number of hours, also had some bad news in them this month. Only got bad news on a Good Friday. The average hourly work week fell, the number of hours that people were working, which is usually one of those things we look for as a forward indicator. If people are working more hours, it means that employers need people there and they're going to look to hire. The same thing with temps. When employers are hiring more temps, it gives an indication that they're going to need to step up hiring. And there was a bit of a pullback. I mean, the good thing is, over the last couple of months, there was a real jump in the number of hires of temps. So this is, I mean, a little bit of a payback. I mean, we have seen 3 months of particularly strong growth. So, I mean, the fact that we took a little bit of a step back, we still had 2 steps forward. We haven't taken 2 steps back yet. So that's a positive.
Okay, well, Phil Izzo, thank you. We're going to actually check out more analysis on the Real-Time Economics blog. Phil will have that throughout the morning, WSJ.com/economics. And we've still got David Wessel with us in Washington. David, this has got to have people in the White House really worried right now, and certainly in the Romney camp a little more excited about what they're seeing. We've got a graphic we're showing you here. March unemployment rates for incumbent presidents, what kind of jobs figures they were facing coming in. And the unemployment rate, of course, dropped in March, and it gives them a little boost, but we're still seeing a big gap, and that's got to have a lot of Democrats worried right now.
Right. I mean, I think, first of all, to go to a point that John made earlier about the numbers, so the Labor Department did revise up the number of jobs that were added in January and February, which is a reminder that we can get all hung up on analyzing this $120,000 job movement in this month, and then a month from now we'll discover it was really 180 or 80,000. So it's good to keep in mind that. Look, I suspect that the spin doctors of both the White House and the Romney campaign had already written their statements before the numbers came out, and they won't be changed at all by what came out today. But basically, I think you got it exactly right, that there are 2 economic numbers that are important to the presidential race. One is the unemployment rate, and that did come down a tick, and that's not insignificant. And secondly, it's the price of gasoline, and that's up a lot. And for the rest of the campaign season, for the next several months, we'll be focusing on both those numbers because we know that those have an impact on what people do when they go to the polls. The better the economy, the better for Mr. Obama. The worse the economy, the better for Mr. Romney. Everything else is detail.